Treasury has released South African Airways' quarterly financial results. They reveal a net loss of 1.8 billion rand in the last quarter. To discuss that, we're joined by the CEO of SAA, Mr. Vuyani Jarana. Good evening, sir. Thanks very much for coming through. Well, let's start with those fourth quarter results released yesterday. Now, far exceeding previous estimates by 1.2 billion.
Yes, far exceeding the previous estimates. I think it comes down to the implementation of strategy. So when we got to SAA, we had to look at how the previous commitment to implement the strategy went. There were very specific things that drove the losses. Firstly, the revenue side. We carried lesser passenger numbers than we had planned. Obviously, the foreign exchange movement impacted the revenue on the sales side, because 50% of SAA's revenues is hard currency denominated. With the strengthening of the rand, then it has the adverse effect in the revenue. But the main thing has been the cost side. There were specific decisions that ought to have made last year, which were not made because of the solvency and going concern issues.
Like?
For example, we're supposed to keep 5 narrow-body aircrafts when the board could not extend contracts for longer than 6 months. It meant those aircraft would have to go. When the aircraft leave, there's what is called return conditions, which means when an aircraft leaves, we're returning back to the lessor. You
still have to pay.
You have to recondition it back to what it was. So all those reconditioning costs were not, though provided for in the plan, but they were not. They were not for the year that we dealt with. So all those were charged in the year that we're ending in March 2018. So a lot of things that are around implementing of the strategy. Those are the things that have made the SA numbers to look a little bit backward than planned.
Now, let's take the first two, maybe one of the first two reasons that you cited. Currency movement, perhaps, but lower than expected passenger numbers. I mean, international sales declining by 11%, domestic by 21%.
So keep in mind that in the domestic numbers, there is also the quarter effect of our movement of 4 aircraft to Mango. So in those numbers of the 20% decline, they are SAA airline, but you saw a 10% increase in passenger numbers on Mango. So the net effect of the revenue decline is combined year to date is about 5%. So domestic, a bit more about the strategy we adopted, less on SAA, more on increased 10% in Mango. So in a sense, the net effect, we are quite comfortable with that, because it's also a deliberate strategy we implemented in Q4.
But why would you be comfortable with that? Because, I mean, Mango, everyone seems to be saying, is doing very well, thank you very much. Just SAA isn't. And you have to, carry the flak for that.
Yeah, but remember, Mango is a subsidiary of SAA. The decision we've made in the market side for domestic is to rebalance the demand, because there's more demand for LCC in seats in the domestic market and less for full service carrier. What was then happening is that SAA was being dragged into the lower segment, the segment that are not the full service carrier. So what we've done, therefore, is to reshape the number of seats to focus on the market. The results of that is green shoots of improving margin. We're seeing green shoots of improving margin in specific routes, Joburg, Cape Town, Joburg, Durban, Joburg, East London, to start to improve gross profit margins. I want to go to the international domain. The reduction on the international domain is largely over and above the exchange rate movement. We have global distribution agents. They are really driven by the market sentiment. This business runs on forward bookings in order to have upfront commitment to fill the aircraft, the flights, 3 to 6 months ahead. Each time there's a sense that SA will not survive, they stop booking us. They say, well, we're not sure we can do forward booking. So just the very fragile position of SAA in the past year has had the effect of undermining the strategy going forward in terms of sales, global sales in particular. Each time we have to go into the market, convince people that we're still trading, we're still there, we're still standing. So a lot of things have happened which has undermined the strategy.
Well, I was going to ask you, but why you're doing this with Mango and not with SA Express, given that you're in the same group and what that means. But in the interest of time, I'm going to skip that. But the results we're talking about could not have been the reason why you and your executives left left Parliament in a half yesterday.
Yeah, I think we need to talk about this, because many people I've seen many tweets saying we left there.
What happened there?
So,
what happened? Parliament through Treasury told us that the session will be held in a closed session of Parliament, so which means MPs and executives would discuss this. When we got to Parliament, the acting chair of Parliament indicated to us that they had made an application through the parliamentary procedure to have this meeting held as a closed meeting. However, the approval said, well, we agree that you can hold in camera as a closed session on condition that the committee had approved. Then the DA indicated that they had not approved that the meeting should be a closed meeting. So there was a disagreement. Now,
so it was a tiff between and among parliamentary
committee members, yes. And then they said, well, they need Hansard to verify if on that date that they had met, that really this resolution was made. So on that basis, the chair of the committee, before we could even start, said, well, because we are not agreeing about this, therefore we are going to postpone the meeting. SAA, pack your bags and go. We'll call you back when we are ready to. We have made a call about how we handle the meeting. Simple, not even one say from our side.
But okay, let's put that aside and say on a principle. I mean, there may well be inherent risks in you divulging or revealing your strategies. But the fact, doesn't that come with the territory? Given the fact that you want public money, you want public trust. So should we not all be able to see and hear?
Absolutely, and I think our approach is simple, is that we are not having an intention to have a blackout on SAA, no. However, to the extent that there are very specific questions on certain sessions that we have to lay our strategy bare, that's very dangerous. We are not a monopoly, we are not Transnet, we are not PRASA, we are not ESCOM, who are in the market of their own. We are competing in a highly competitive industry. By the time we start implementing, the competitors counter us immediately. So it's very important that to the extent that you want details of our strategy, we need a degree of protection in that sense. But the public representative are there, they are elected by their constituency, by the people. So we see no reason why that would be seen as perhaps not wanting to be transparent. We're quite clear we want them to see everything. But also I would hope to be on the other side. If I was on the other side of the competition, I would love to be in that space, because I see the competitor laying bare its own strategy every day. So it's not good for competition.
But that understanding you had was only for this strategic plan.
Yeah, what we had said in the discussion with SCOF in a number of times, we have said to the extent that they want detailed issues which had to do with SA, they're going to drill deeper. We would like a degree of protection, but there's no intention to say all SA's meeting with Parliament should be held in a closed session, no. But when they ask us for detailed things that will affect our strategic intent, we said, well, we would want to share those details with them, with the comfort that they are protected.
Now, yesterday you were meant to brief Parliament, of course, about that turnaround plan, for which reports say you need 21.7 billion to finance over the next 3 years. Now, that's 29 and 9 zeros. That's a lot of money in South African terms, given the country's other challenges. What is it for?
Absolutely. If you look at SA today, SA has a 9.2 billion rand debt. That debt matures in March 2019. And there's nothing we can do with it. It's history. And it's a history that we own, we appreciate. As new people are coming in, we acknowledge it, we need to deal with it.
You need to settle.
So we'll put it aside. Now, the plan we've put in place has a path to profitability that's in 3 years' time. So that path needs support from a liquidity and cash working capital injection. Now, having looked at that, you need about 12.5 billion rands over the next 2 to 3 years to get to a point where SAA will be able to pay for its own operations and be profitable. So it's a choice that we've put to the shareholder to say, here is the plan, committed to execute on it. We've started executing on it. If you believe on the plan, we have to find the right financing mix or funding mix to make sure we can get there. Part of it is a strategic equity partner. Part of it is shareholder capital calls. Part of it will be partly debt. But SAA cannot attract debt in the current form unless there is commitment to inject capital or we are able to get through the SCP process, which the board will be discussing in the next couple of weeks.
Is that the reason financial institutions aren't keen to lend you?
Well, there has been a number of reasons. Obviously, one of those reasons is that the financial institutions believe that the current debt profile of SAA is burdensome to the organization. One of the things they wanted to see from us is a date in the future when SAA can be able to pay for its own cost, which is break-even point. Secondly, they are looking for a path to debt reduction, acknowledging that in terms of the capital structure, the current debt profile of 9 billion rands for the current business plan is not sustainable for SAA. So we have to reduce that 9.2 billion rand significantly and push to grow the business and extract costs out of the business to make sure we have a very good fit for growth kind of airline which we are building today.
Surely getting clarity on the strategic equity partner would go a long way towards instilling confidence even among lenders that you are for real if someone is willing to trust you or to be part of you.
Absolutely, and I think it's a very important point because many commentators have said take SA to business ratio and sell and so on. And the government has made this call to say find a partner to invest. I think South Africans must realize that finding a partner in a business is not as simple as selling a commodity. These kind of deals, they take 18, 24, if not 36 months to make them work, to actually go out and find and do the M&A activity. However, there's bigger commitment to start that process. We must underscore, though, that if you start this process in a fragile moment, you might not be attractive to many suitors. However, we don't have the luxury of time to wait. I think the board is going to discuss this and take a resolution, and we move forward. We do believe, though, that the right position for SAA to get an SCP would be once you break even, having dealt with all your issues. But given the current circumstance, I think we're going to take a step forward and look what's in the market.
Which then means, I mean, if you're not attractive to potential equity partners, the burden is then on the state, whether through money that they give you or, of course, processes that they have to underwrite. But here's Maisha. Remember, every CEO that has come before you has gone to Parliament and said pretty much what you're saying now, that I have a plan, and if you give me the money and give us the guarantees, we won't have to come back again. But
absolutely,
we know the truth.
Absolutely. I'm 5 months in the job now. We've set up a change hub. We've done something very different in terms of rationalizing the market. We've looked at routes where we're losing money, and those routes have made hard calls, and calls that are largely unpopular, but we have to do what is good for SA today. And we are talking about people are saying we're shrinking. Our view is that we have to be fit for growth. Part of fitness for growth is to make sure that you look at those areas where you are losing money. If every flight I fly, I get negative gross profit margins, there is no point flying. I'm flying that flight for charity. So we need to look into that. Now, we're busy with the restructuring. We've set up a change hub, which is where the nerve center of execution of this project. And from what people are telling me, the people who have been there, it's unprecedented in SAA, so which is good. It's a good sign. We're seeing the green shoots of some of the domestic routes. The Central Africa, after doing rationalization, we're seeing good signs. If I look at East London, good signs. Cape Town, Durban, we're seeing green shoots. We're going to see results of the London consolidation at the end of this month. So if you just look at that, there's already action being taken. The next stage is to look at the internal cost structure of the business and make sure that we rationalize it to be fit for growth.
Well, which brings me to my next point, which is that when people compare you to other airlines of similar size and profile, they say you have more people than you need. You yourself, in fact, I think it was your chairperson who said there is a problem of skills at the most senior level. How are you addressing those?
So obviously what we've done, we've looked at the simple basic issues of ratios, and it's clear that we have to get greater productivity out of SAA. Part of it is to remove all the other elements that are limiting how we can be more productive, whether it's pilots agreements in terms of how we manage we have an industrial relations or contract with them, whether it's the sheer numbers and ratios, people to cabin crew to aircraft, pilots to aircraft. We're dealing with those things inside SAA. So in order to make sure we build a fit for growth kind of airline, there will be no holy cows. We are going to have to deal with all the hard issues in order to ensure that we can deliver on the strategy. We are benchmarking our cost structure. We are talking to global airlines, looking at what they can do with some of our pilots who are sought after throughout the world. We're also careful that we are going to grow. We don't want to lose key skill because we're in a point of pain today. So taking hard decision around cost structure, rationalizing workforce. We are talking about with labor every month, we're discussing what are the options for us to actually first preserve jobs, secondly, go to a point where we build a fit for growth aligned with the right size of staff, right ratios of staff to revenue.
On a lighter note, you know that there's a British traditional leader who's getting married this weekend, and one of your competitors is giving away tickets to those royals. You're not planning to outbid them?
Well, this is a marketing thing, so I mean, we'll be looking at our marketing team, see how we can. So we probably will be looking into it. We are really trying to bring a lot more innovation into our marketing space within SAA. So very strong airline. We have isolated a lot on the core airline side, despite our challenges to keep the flights going, making sure the operation is robust, on-time performance is good, and then deal with the overall corporate challenges within the SAA airline.